1929. The Great Crash erased 90% of wealth in just 3 years. Now, imagine I told you that America's banking system is currently sitting on over $500 billion in hidden losses. That's 4 times the risk level that triggered past collapses, and almost nobody is talking about it. The year 2026 could be the year the entire U.S. banking system finally reaches its breaking point. But it won't be from one huge, catastrophic event you see on the news. Instead, it will be from 3 silent failures, all happening simultaneously right now. These failures are so dangerous that the mainstream media can't discuss them on air without causing a panic. Regulators can't publicly acknowledge them without triggering bank runs. And worst of all, these failures will hit your savings, your job, and your dollar long before they ever touch Wall Street. Now, this isn't fear-mongering. This is cold, hard mathematics, backed by Federal Reserve data and official FDIC reports. The financial system didn't just develop a few cracks in 2024 or 2025. It's been fractured for years, and 2026 is when the numbers suggest everything finally breaks. If you have a 401k, if you own a home, or if you simply keep money in a bank account, this story affects you directly. And today, I'm going to walk you through the evidence that Wall Street desperately hopes you'll never see. Right now, if you look at any major bank's earnings report or listen to their executives on financial news, you'll hear that everything appears perfectly stable. Deposits seem solid, quarterly profits look healthy, and the CEOs confidently reassure everyone that the system is sound. But here's what they're not telling you. Behind those polished presentations and confident smiles, US, banks are currently sitting on over $500 billion in unrealized losses. And those losses are directly caused by the high interest rate environment we've all been living in. This isn't a guess. The FDIC quarterly banking profile confirms this number. And if interest rates stay high into the middle of 2026, those paper losses could crystallize into real, irreversible capital destruction. So let me explain what this actually means for you, the average person. When interest rates rise as dramatically as they have over the past few years, the value of existing bonds and other long-term securities held by banks absolutely plummets. Picture this. A major bank purchases a 10-year Treasury bond for $100 back when interest rates were near zero. Now, fast forward to today. That exact same bond is only worth maybe $70 on the open market, because newer bonds are being issued that offer much higher yields. But here's the accounting trick that should genuinely concern you. That bank is still allowed to list that bond on their balance sheet at its original $100 value, not its current $70 market value. They can do this under current regulations, as long as they claim they intend to hold that bond until it matures years from now. This is the exact same accounting deception that Silicon Valley Bank used, right up until the week it spectacularly imploded. Now, take that single massive loss and multiply it across every single major and regional bank in America. This is the hidden time bomb, and its timer is ticking down toward 2026. The problems are buried deep inside the balance sheets, hidden in plain sight, and the consequences could be staggering. So, what are the other 2 silent failures I mentioned? The first is the one we just covered, the massive hidden losses on bank balance sheets due to high interest rates. The second is a commercial real estate crisis that's unfolding in slow motion. Think of all those empty office buildings in major cities. The loans on those properties are coming due, but with high vacancies and lower property values, many building owners won't be able to refinance. The banks that hold those loans are facing colossal defaults. The third failure is the quiet decline in consumer credit. For months, people have been using credit cards and personal loans to keep up with inflation, but now delinquency rates are spiking. As more people default on their car loans, credit cards, and mortgages, the banks that issued that debt are left holding the bag. Each one of these problems on its own is serious. But when you have all 3 converging around the same time, around 2026, you have the recipe for a perfect storm. It's a chain reaction where losses in one area put pressure on the others, creating a domino effect that could threaten the entire system. This isn't about panic, it's about preparation. The second crisis isn't on the horizon. It's already here, destroying value right now, and it's accelerating faster than most people realize. Commercial real estate, the very backbone of our cities, is in an absolute freefall at a pace we haven't seen since 2008. And here's the number that should keep you up at night. A $1.5 trillion commercial refinancing wall is set to hit between 2025 and 2027. Why is this happening so fast? 2 massive factors are converging at the worst possible time. First, the permanent shift to remote work has obliterated demand for office space. Companies that once needed huge floors now need a fraction of that, if anything at all. Second, the buildings still in use were financed during the era of ultra-low interest rates. Those commercial mortgages are now resetting to today's much higher rates. A property that was profitable with a 3% mortgage is a financial disaster at 7%. The cash flow just doesn't work, so owners are simply walking away. And here's the critical detail. Banks hold the vast majority of these loans. Not hedge funds, not pension funds, but the traditional banks where we deposit our paychecks. When these massive properties default, banks absorb those losses directly. This isn't theory, it's happening right now. Major cities are watching trophy properties sell for half their 2019 value. Some iconic buildings are being auctioned for pennies on the dollar. This isn't a correction, it's a structural collapse, and it's pulling banks down with it. For generations, the American consumer was the most resilient economic force on the planet. That era is officially over. Credit card debt has soared past $1.2 trillion, an all-time high. Delinquencies on credit cards and auto loans are rising at the fastest pace since 2009. Personal savings rates have collapsed to near record lows, meaning most Americans have no financial cushion for any kind of shock. Here's the brutal reality. Americans aren't just broke anymore. They're actively borrowing money just to maintain being broke. They're using credit cards for groceries and taking out new loans to cover old debt. When consumers begin to fail, banks fail right behind them. Banks depend on three critical revenue streams: consistent loan payments, regular credit card repayments, and steady mortgage payments. All three are deteriorating at the same time. This is the second structural crack forming under the banking system. Now, let me explain the part almost no one is talking about, and it might be the most dangerous of all. The US government has borrowed such a staggering amount of money that it is now actively crowding out the entire private banking system. Here's what that means. Every dollar that investors put into US Treasury bonds is one less dollar available for bank deposits. Banks cannot function without deposits. It's their lifeblood. But deposits are leaving the banking system at the fastest rate we've seen in over 50 years. Where's all this money going? It's flooding into money market funds and Treasury ETFs that offer better, safer returns. Compare a high-yield government bond paying 4 or 5% to the average bank savings account paying maybe 0.2%, and the exodus makes perfect sense. Depositors are simply following the money. A banking system that can't hold onto deposits isn't really a banking system at all. It's a house of cards waiting for a slight breeze. Major financial crises don't happen because of the big, obvious problems everyone sees. They happen because of a trigger event, an unexpected spark that ignites all those vulnerabilities at once. In 2008, the trigger was Lehman Brothers. In 2023, it was Silicon Valley Bank. In 2026, the trigger could easily be any mid-sized regional bank finally admitting it's insolvent from its bad commercial real estate loans. History shows us that crises don't happen because of insolvency. They happen because liquidity disappears in a matter of hours. And right now, all the conditions for that spark are in place. Have you ever wondered what happens when the financial system finally runs out of tricks? We're not talking about the giants of Wall Street, the ones too big to fail. We're talking about the regional and mid-sized banks, the ones without the political connections to guarantee a bailout. Imagine this: one failure at the wrong bank, a weekend of panic withdrawals, an emergency seizure by the FDIC. Suddenly, the entire system is forced to reveal everything it's been hiding. All those unrealized losses sitting on their books, the bad loans they've been pretending are still good, the liquidity problems they've been masking with accounting magic, and the deposit flight they've been downplaying on earnings calls. It all becomes public all at once, and that's when the real panic begins. If these structural cracks finally break open into a full-blown crisis in 2026, history gives us a pretty clear roadmap of what to expect. First, a regional bank will fail, probably over a weekend to minimize the initial shock. And within hours, federal regulators will step in, announcing temporary guarantees to try and prevent widespread bank runs. The Federal Reserve will immediately restart those emergency liquidity programs they told us were finished years ago. Then, the Fed will start slashing interest rates, trying to pump life back into the system, even if inflation is still uncomfortably high. But here is the dangerous part. Those rate cuts and liquidity injections will likely cause inflation to spike again, maybe even higher than before. As global confidence in the U.S. financial system erodes, the dollar will weaken significantly against other currencies. This leads to a truth nobody in power wants to say out loud. You can save the banks, or you can save the dollar, but you can't save both. As this reality sinks in, depositors will panic. They'll pull their money out of traditional banks and rush into money market funds, draining even more capital from the already struggling institutions. This triggers a second wave. Banks that survived the initial shock will now face a new crisis of confidence and a severe deposit drain. Some will be forced into mergers, some will be seized by regulators, and others will just quietly disappear. Now, this isn't some doomsday prophecy. It's not just speculation. This is the natural, predictable outcome for a financial system under this much stress. We've seen these patterns play out in every major financial crisis before. For most people, the 2026 banking crisis won't feel real until it hits their own bank account, their job, or the purchasing power of their money. But for those who are paying attention, every single warning sign is flashing right now. The question isn't whether the system is cracking. It clearly is. The real question is how much of it will be allowed to break before the government is forced into another massive system-wide intervention. And what will that intervention cost us all? In a crisis, speed is everything. The consequences of this will reshape American finance for the next generation. If you want to know exactly which banks are most exposed to these risks, and more importantly, what you can do right now to protect your own finances, make sure you're subscribed and have notifications turned on. In the next episode, I'll break it all down. Because 2026 isn't the beginning of the crisis. It's the moment the old system finally runs out of time. Thanks for watching.